This is a special Waupaca City Council meeting.
Special City Council meeting. I do call this meeting to order, and let's begin with the Pledge of Allegiance. I pledge allegiance
to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
In attendance, we have all of our council members are in attendance. Dave Peterson, Eric Olson, Paul Mayo, Chuck Whitman, Steve Hackett, Alan Keelan, Lori Chestnut, Scott Pachatsky, Paul Hagan, and Jillian Peterson, and also Mayor Brian Smith, as well as staff members. You have an agenda, which is all related to the budget. We would need a motion to approve. You know that Josh did send out a packet today, or I think it was today, right, that ended up on your website. I don't know if we, but that would be the one addition that we have to this. I don't know if everybody received that. If you didn't, do we have paper copies of that
I
too?
have paper copies for a couple of the members that have it, but I can make more if
Okay.
it's necessary.
Well, I printed mine, so I don't know. Who does need one?
Yeah, I need one.
You want paper, and otherwise they're downloadable off of the website.
Paul, if you have your
This afternoon.
laptop. you
This
should-
afternoon.
I checked at noon, there was nothing.
Yeah, no, I just finished it about 3 o'clock this afternoon.
That's why I missed it.
Okay.
So
Yeah,
I need
so-
one if you want.
So we,
How many copies do you have?
I don't have any, I'd have to make more.
Okay.
Here, there's one for the, can you share it?
Maybe they could share over there, yeah.
She is planning to put it up on the screen.
I am going to be
This
putting it up on the
information so
screen.
you can see it.
Oh, okay.
You might be able to see it better on the screen.
Yeah.
For sure.
Do you want to turn the light off over the screen?
Yeah.
Sure.
Good idea.
We need a motion to approve the agenda with that addition that came out on the website or the paper one that we have.
Move to approve.
Motion by Keelan. Second by Mayo that we approve the agenda with that additional handout that we received today. Any discussion? All in favor signify by saying aye.
Aye.
Against? Motion carried. Let's move on then. We're going to do the utility budgets or our enterprise funds first. We're going to start with the, now let me tell you what I'm hoping our goal is tonight. Our goal is to review the utility budgets, the water, the sewer, and the Waupaca online. And if you feel comfortable enough, we'd look to try and approve each one of those budgets separately. If you do not feel comfortable approving those, then we will move those on to a future meeting. But those three we're looking to try and get an approval tonight with the information that Kathy is going to be handing out tonight. The other one, the general fund, although you have the opportunity to approve that, we're not expecting that there will be approval on the general fund budget tonight. Okay, so without Henry, anything you need to add?
No, I thought we'd just get right into it. Kathy's been working diligently on this. I do appreciate everybody's patience. She's taken a lot of time to sort of get her arms wrapped around the budgets from the past years, and I think that has probably taken a little extraordinary time than maybe initially planned, and she feels good about where we're at, and I'll turn it over to you, Kathy.
Okay. I hopefully can get the, is that right? Is this?
Doesn't look like it's on.
Is it turning on now? Okay. that's not what my screen looks like. That's my screen.
Gotta do.
Very artistic.
Yeah, no. Need help, Dave Peterson's here available.
Better yet, see Josh is here, he's all right.
He is so good. Okay. All right.
Got a pointer for her?
It's too hard to get these things to work.
Get this figured out. I mean, it's really hard to read. Yeah, I'm in the PDF right now, so how come? I'm sorry, I'm a little technically challenged with this setup, so.
Can you do like Control Plus?
Ah,
Oh, there we
it does know what to do.
You better.
Yeah.
Right, now I need to page down.
No, it's too big for the screen.
As you get older, you use that more.
Yeah. Just, hey, I can read it.
Well, right. Oh, and he learned it from Steve.
Okay. So how do you get it?
Go the other way,
That's good
guys.
enough.
No,
I wanna do-
Get a bigger screen, Josh.
All right. The water fund that's up on the screen shows the revenues and a summary of the revenues. And what it is mostly water sale revenue and miscellaneous revenue, which includes borrowing with a clean or safe drinking water loan to fund the loop projects that were discussed earlier. And that's why you're seeing about a $470,000 difference between the miscellaneous revenue from 15 to 16. When you get down to the bottom line on the water utility, being very conservative on the revenues, looking at trends over the last few years of revenues not being at what budgets were projected to be. We're showing a shortfall of about $332,000, which is about the same amount that we put aside for depreciation each year on the plant. So if you remember, depreciation is expensed. However, it's a non-cash expense. It's really just a book expense to the utility. It's to set aside funds for replacement of the infrastructure and equipment in the future. So if you really looked at it, it would probably be a balanced budget. However, we are all looking for going for a rate increase, a simplified rate increase, which would not require a public hearing, but would give us a 3% lift in the, not the fixed charges, but for the volumetric charges. And so the last simplified rate case that was done for the water utility was July of 2011. So I think it's prudent to look at an increase, inflationary, if you wanted to call it, after 4 years, 5 years, to do a simplified rate case. We can easily do those within 60 to 90 days, and they could be, we could start this effective once you pass this budget and have it effective as of January 1st. So there's some options with that, but that's strictly coming through with including the $470,000 for the loop projects in capital outlay.
Kathy?
Yeah.
What does the PSC say our return on investment should be?
Anywhere from a low of 3.75 to a max of 6%. They are looking for a rate of return in that range. I'm estimating that if we did not go with a rate increase, we would probably look at just over a 3% rate of return.
We did not. Okay, so if we do, where would it be at?
We probably would be just over 4.5. I'm not us being at the max.
I understand.
Only because what happens with the water utility as far as the sales revenue is that our costs still continue to increase, but everybody's volume of water that they use because of conservation is going down. So that rate needs to be enough to cover what our costs are.
Being as we haven't raised our rates since 11, are we behind on return on investment from those years?
I don't think so. And looking at the financial statements, you've been under 6. However, going forward, I think, you know, some of the bigger projects that you've had to issue debt for would caution me to say that you probably weren't meeting all of your costs, you know. And then so what you end up doing is taking money from your retained earnings, so your cash. And I've been in several water utilities who've paid cash for infrastructure in the past and had really healthy rates of return at 6%, but went on this, I'm going to spend everything, and they're now in the red. And one utility that I just was at had to have a 54% rate increase. So.
Yeah, just to preface, we're not suggesting any sewer rate increase.
No.
But consideration for this, for just the water fund.
For just the water.
Kathy, this would allow us to build our cash on hand. You talked about the depreciation, you know, is in here, and it, you know, you have the $300,000 deficit. Using the depreciation, if you took it out, it'd be balanced. Now, with the rate increase, am I getting the economics right here that it would allow us to be more profitable, which would allow us to have more cash on hand?
Correct. So that if we did have to buy something that, you know, if it's a truck or something like that, you wouldn't want to borrow for it. Then the utility could easily pay cash for it.
And that's more of the way we want it to be. So this is going to allow us to, you know, get to that point, right?
Correct. Yeah. I'd rather see a very healthy cash balance with the water utility. One, it helps the city overall for cash flow. So I think that it's much more prudent. The other one is then what you're looking at is a very good core cash reserve that I can go out and invest long term. Right now, the city's been on a 1-year CD at local banks where we're getting less than 1%. The latest return rate that I was quoted was 95 basis points, whereas I could go out in a 5-year government agency and earn, you know, 165 on, maybe a 6-month callable. At least then I'm getting at least 165 for 6 months. But the other one would be is even looking at investing in other municipal debt. You know, other municipalities do issue debt, and they have a very good rate that we could go to and purchase some of those bonds off the market and hold those as our core, and then it's earning 2 and 3% on the coupons. So I think that there's a better ability to make this utility profitable in that maybe gets more interest earnings instead of, and hold that core cash out in longer term and not use it to borrow for, you know, or fund other options. Okay?
Thank you.
Kathy, one question. I see the title of that is depreciation and taxes. We aren't really paying taxes, are we?
We pay the city, the water utility pays the city taxes.
Okay.
So it's a payment in lieu of taxes,
Right.
and it's based on the infrastructure that's in there. So there's about 200 and some $1,000 that's also out there for utility taxes.
Okay.
Any other questions? It's a very healthy fund. I would want to make sure that we don't get behind the 8 ball with the rates and just have small increases, because if we start doing a lot of infrastructure projects, it could come that when we go for a construction authorization from the PSC, they may look at us and say, you know, you need to go for a full rate. And then you're opening yourself up that, you know, why do I have to go for a full rate? And you'll see more than a 3%. And we might not get the full 3%. It depends. That's the max that they usually give, but they'll look at what our expenses are and what our revenues are and based on trending and standardization that they have, and determine what that rate is. But the most that you can get is a 3%.
There are a couple of items in there that have been increased, and can you just touch on those?
Sure.
I'm not talking the depreciation and taxes or the capital outlay, but like the operations storage facility, and transmissions and distributions.
Right. Yeah, go ahead, Justin.
All right, the operation storage facility, that's $15,000 increase. We are required to do our water tower survey and inspection per the DNR. That is not an every year thing. However, it is coming up that 2016 is the year for the Mount Tom water tower. So the contracts in the past have been in about $12,000 range. So and I think the last one was about 5 years ago. The next one down, the transmission and distribution, is part of the cross-connectional control program. This is a requirement through the DNR and the Department of Safety and Professional Services. That is increasing. I think if you scroll, or if you look over to the left, we were requesting 58,938. Last year, 48,000 was requested, and the year-to-date estimate, that 37,000, I believe that's a typo. That should be 57,000. So it's based on the historical trends and what we're anticipating next year. This is basically a contracted service outside through HydroCorp. We try to work with them to control the cost. They do almost all of the commercial and industrial inspections. We do the residential. So that's just the traditional trend where it has been exceeding the cost every year. So we're trying to get that balance there. Couple lines down, the records and collections, the 5,255 is just additional money needed for the new accounting software, once we get that implemented. Office supplies and expenses tied in with the accountant software. The $5,000 with the outside services deals with our leak location study. Again, this is not a required program, but it's strongly encouraged through the Public Service Commission. We need to keep our percent loss down below 15%. So this program helps us keep it down below 10%, which is our goal for the water department. Any others?
Kathy, I can't remember what you told me about the water sales revenues. Does that include the 3% increase?
No, that does not.
So, okay, so if we were looking at it from a standpoint of approval tonight, we would be, if everyone's okay with this, we'd be looking for an approval of the water utility budget, but then we would also, this same meeting, you would be looking for a motion to approve
Simplified rate case.
so, and you would like to see both of those done tonight if possible?
Correct.
Okay.
Mayor, can
Yes.
we do that when it's not on the agenda?
Well, I think it is.
Okay.
Part of the
I don't
water
have a
fund.
copy of the agenda.
Yeah.
Yeah,
Depends on how you read
It's
it.
on there.
yeah, it's under the 6A. Yeah, sorry about that, Steve, yeah.
Can we make that motion now?
Yeah, we can make either or,
Oh,
or both.
I
I
would,
mean, let's do them in separate motions if you're okay.
sure. I would move that we approve of the water utility budget for 2016.
Second.
A motion by Mayo, second by Hagan, that we approve of the water utility budget as presented. There was that one correction, which is really nothing to do with the budget, but in the blue there, Justin said that number for the, what was that, outside services?
Transmission.
Yeah, transmissions, that should actually be 57,597 instead of 37,000. Which makes more sense than when you look at the,
It's just an estimate.
yeah. It's okay. All right, any other discussion? If not, Henry will take the roll.
Dave Peterson.
Aye.
Eric Olson. Paul Hagan, or Paul Mayo, sorry. Chuck Whitman.
Aye.
Steve Hackett.
Aye.
Alan Keelan.
Aye.
Lori Chestnut.
Aye.
Scott Perchatsky.
Aye.
Paul Hagan. Jillian Peterson. 10 ayes, 0 noes, motion carries.
I'd also move that we approve of the simplified
Rate
rate
case.
increase for 2016 of 3%.
Okay, we have a motion by Mayo, a second by Olson, that council approves a 3% rate increase using the simplified rate method. Any discussion? Again, if no other discussion, Henry, you will call the
Sure.
roll.
Jillian Peterson. Paul Hagan.
Aye.
Scott Perchatsky.
Aye.
Lori Chestnut.
Aye.
Alan Keelan.
Aye.
Steve Hackett.
Aye.
Chuck Whitman.
Aye.
Paul Mayo. Eric Olson. And David Peterson. 10 ayes, motion carries.
Okay, next up then is the sewer fund.
Okay, the sewer fund again, I did some trending on the revenues and definitely there is another, because of the conservation of water, there is I'm not estimating that you're gonna collect as much revenue as you think you are budgeting in 15. So I always trend a little bit conservative on revenue estimates based on trends and have reduced the revenues coming in. Be that as it may, we are looking at only a $61,000 net revenues under expenses because we have reduced our debt service costs with the sewer utility, and we have reduced some of the operations and plant costs. So my recommendation is to not increase the sewer utility, but also go out and do $155,000 worth of capital projects, and Justin can go over those items and pay cash with the equipment reserves that we put aside. So we have, in the past 4 years, done a 1% or 3% increase in the sewer rates. You did a 1% in 14, a 1% in 13, a 3% in 12. And I think at this point, the sewer fund is in good shape since the debt has been paid off. And it's only has out there some smaller issues that we can operate with what's available in revenues. So if you did put the depreciation cash back in, which is about, I'm trying to, another 200,000, it's in cash positive for the fund. So that's why I'm not recommending any rate increase for the sewer fund.
So the depreciation on this page is included in what, the debt service?
In the debt service, no, other general expense, $313,000.
Okay.
So there's enough money set aside that this is a positive cash flowing utility that I recommend that it's good where it is.
Is there a reason why we don't break out what the depreciation is?
It's just, right now, I have it summarized into categories. I can, in the future, break it out. I'm just looking at trying to get everything to fit on one page. So I kind of put other general expense and stuff into a one lump sum.
In the future, I would like to see that breakout. So depreciation is separate from taxes as well,
Okay, we can,
and separate from general
sure.
general
I
expenses.
can make those two big, or I could correctly report them and show you that this is the total expenses, then you have depreciation and taxes, and then, what you have on the bottom. I can change that so it looks more like the financial statements.
Okay.
So this is actually going to show a positive cash flow then if you were to subtract out the depreciation?
Correct.
So that just adds to the fund balance then, or?
Well, it becomes restricted fund balance or retained earnings because it goes against the capital assets that are on the balance sheet. So
Restricted, and it can only be used for
capital.
Okay. Everybody understand? Clear as mud?
I might have to give accounting 101 lessons, but I think that going forward, that's going to be most of the utilities' concern is as conservation becomes more prevalent and the reduction of what goes through the meter, and that's what generates the revenue to operate the plant. And your plant is getting older, so there's some need to start putting aside funds to be able to handle the conservation or change your rate structure that you do a conservation rate. And I know some municipalities that their utilities are looking at that, where you reward people who don't use a lot of water, but you have, the other option is where you have commercial customers that use a lot of water, and they are getting a discount, so you have to balance it. So there's some give and take, but based on what we have here, I think it's a good fund, and don't recommend a rate increase.
Kathy, do we have a requirement to keep a certain amount of a fund balance, the sewer?
Unless you have a fund balance financial policy for the city,
Which we don't for sewer and water.
you do not have any requirements. The sewer utility is unregulated by the PSC. You have an unregulated sewer utility, so it's up to the council to determine financial policy and what it does. We just follow regular GASB accounting methods for proprietary funds. That's all we do.
Have you seen in your travels that people do have fund policies in the utility?
Yes, I do.
So I think that would be something we should look at
Next year will be part of the capital planning, in doing some of that, and that we can bring back forward some model policies that can set what we're expecting for the utilities. So there are some recommended practices out there.
Kathy, I have a question.
Sure.
For our 15 budget for other general expenses, we have 313,000, but estimated year-to-date actual is almost $500,000 more. Why is
It might be a typo.
811,000 for year-to-date actual?
Let me,
It's other general expense.
it would,
2015 estimated year-to-date actual is 811,000, but yet our budget is 313,000. Is that a typo?
I'm looking at it right now. There's $496,000 worth of depreciation. There's $250,000 in taxes paid to the general fund. There's $37,000 budgeted for property and liability insurance. So I'm thinking that it's the doubling up of the depreciation. There's extra 500,000. There's 500,000 in there, and it shouldn't be that high. So that needs to be adjusted. Okay.
Well, if you look at the 13 and the 14, though, they're in the 700s.
That was my
So
next
really,
question.
the 15 is the anomaly there. That's been reduced quite a bit.
You mean 16 is reduced?
Yeah, I'm
Okay.
sorry. Yeah. Well, even the 15 current budget.
Yeah.
So it looks like something happened in the budget. 15.
In the budget, and that could be, I can look into it, but I want to say this, it's not going to make any difference where the fund is ending up. It's not a cash expense, is what I'm going to tell you. Okay?
Okay, so it didn't have anything with us
No,
using money.
no.
I think that's your question, isn't it, Paul?
Yeah, it's not money.
Okay.
It's probably an auditing thing. I'm pulling the actuals off of the financial statements, so there could be an audit adjustment that's done. That's just cash. That's not cash related. It's just booking something that I'm not picking up in the budget.
Okay. Anybody else? Feel comfortable with a motion on the sewer utility fund?
Mayor, I'd move that we approve of the that sewer utility fund for 2016.
Second.
Prochatsky, I'm sorry. Motion by Mayo, second by Prochatsky, that we approve the 2016 sewer utility fund budget with 0% rate increase. Any discussion? Henry will call the roll.
Paul Hagan.
Aye.
Scott Perchatsky.
Aye.
Lori Chestnut.
Aye.
Alan Keelan.
Aye.
Steve Hackett is indisposed. Charles Whitman.
Aye.
Paul Mayo. Eric Olson. And Dave Peterson. Not,
Jillian.
oh, Jillian, I'm sorry. Aye, sorry. 9 ayes, motion carries. Oh, I heard that.
Oh, sorry, was the mic on?
We didn't hear it over here, man.
Okay, next then we have the last of our utility budgets, or our enterprise funds, and that's the Waupaca Online.
The Waupaca Online is going to end up 2015 in positive due to the fact that the payable that was out on the balance sheet for the AT&T settlement didn't come in as high as what was set aside. So there's an extra $12,000 coming back into the fund to make it more, how would you say, balanced. The other thing that goes for 16 is that we are going to be, how would you say this, fully depreciated on our capital assets. So because they're technological assets, they don't have a 20-year life. They usually have anywhere from a 3 to 5, maybe 10 year life on that, because technology does change. So the recommended depreciation life of the technology isn't a long-term type of asset. So what happens in 16 is that instead of putting aside $20-some thousand a year for your towards your capital assets, you're going to only put 10 aside. So that one gives better, based on your service revenues and the fact that you have now about $20,000 for the bandwidth fee that we are charging. You've got extra revenues than you had in 15 and in prior years. So this fund is in really good shape cash-wise going forward. The only thing I would recommend is that of the revenues over expenditures, that maybe only a certain amount is set aside for unrestricted, and that we start allocating monies for additional capital purchases that can be done with cash. So we may do an allocation of fund balance, not that it's restricted, but that it's just, I'm trying to think of the new word that they have. It's just kind of reserved for capital. But this is a really good, this fund is in a really good position. We've, in the past, one is 13 shows that it was negative unrestricted, and that was because of the AT&T payable out there. In 2014, it was negative. It would have been positive. However, we wrote off about $20,000 worth of very, very old receivables that were on the books. And so to make this fund more current on its receivables, right now it runs only about $3,000 a month in accounts receivables that are outstanding each month. And we are getting aggressive with collections that I can see this fund being very, very profitable going forward. As you can see now, once that restriction's gone, you have $47,000 in cash, true cash in that fund at the end of the year in 16. And that's not with any rate increases to its subscribers. There is going to be, with the new financial software, some cost savings to the online utility in that we are combining our utility customers that have online into one bill. So you won't have, this fund won't have this expense of sending a bill to everybody. So everybody will be, that has online and a utility bill, will see their online charges on their water and sewer bills. So we'll do some cost savings too with because of the new software. But otherwise, I don't, unless anybody has any questions.
What we did this year, I think, in one of the efforts to bring the general fund into balance, a few years back, and I can't remember, we used to charge some, my time, Josh, and others to the fund, and stopped doing that to try to help bolster this fund. I think to help meet our targets in the general fund, we moved this portion of
yeah, 10% of Josh's of salary and benefits to
this
the
fund, because he
utility.
works on this and it seems reasonable. So that's a good thing that we're trying to move to that.
Right,
And the fund can support it.
And Tina's position's been 5% for several years. So that's all, that was in the 2014 and 15 costs. No, it'll be Tina and Josh. That's all that'll be going over to the online in 16.
Kathy, Josh and I actually have been talking about this, and looking at historical data, I think I have it figured out, but I want to make sure. When you go back to 2013, when we did we showed the actual AT&T expense, right?
Correct.
It looks like we also subtracted it from our fund balance, even though we didn't actually pay it out.
Right.
Okay, so now when we paid it in 2015,
It doesn't,
already been accounted.
it's already been accounted for. So it's run through the income statement in 13. So now the fact that in 15, it didn't use all of that reservation of fund balance, it's now coming back into the fund balance, what that extra, that was savings that they negotiated lower than the 52,000.
Okay.
So that's why you see that it's going to be more positive at the end of 15.
All right. It makes sense. It's not the way I would have done it, but it makes sense.
The auditors did it for you in 13. So, and even though you had budgeted that expense in operations, I'm showing it not in expense on here. So you had it included in the 15 budget, another 52,000 to spend, and you don't have that. You don't need to do that. So I did correct the document.
Yeah, if you take the 13 and the 15 and put them together, they.
Mm-hmm.
Okay.
So otherwise, there isn't anything else in this fund. Josh?
I'm just curious, in the packet, you've got revenues for next year for online at 148,000, and I estimate based off trends and where I know we're going about 132,000. Just curious what changed with that. It's pretty significant growth for 1 year. I don't see our customer base growing that fast.
I am budgeting based on that, I think we've got that $16,000 in business subscriber, is what was budgeted last year versus you feeling that there's about 12,000 in subscriber fees collected for this year that might be a little overstated. You also, but there was also an increase for non-city business subscribers. I think the biggest hit is that bandwidth fee. You know, you're anticipating collecting 20,000, and as of the end of September, you were at 17,000, and not knowing more of what that bandwidth fee is.
Bandwidth fee is something new that we started partway into this year. We just split up where the expenses went because we want the bandwidth to cover our internet costs. So what was put together for this year was different than what we ended up.
Yeah, so I'm looking at, you know, the fact that you have that bandwidth fee, and maybe it might be a little bit overestimated on the subscriber for business fees. I still think at the end, you're still going to have, you know, enough revenue to cover your expenditures.
I don't disagree with that. I'm just questioning 13 and 14. We averaged about $120,000, and we have about 220 customers for our customer base. This year we're about 230 customers right now, and looking at 130 grand in revenue, and to jump an extra 15 and a half grand in 1 year.
Well, that's because you're looking at that bandwidth fee. That bandwidth fee is going to be, you didn't have the bandwidth fee in 13 and 14.
No, but that was a subtraction from the residential and business line items going to that because we changed how the billing was
Okay.
ran this past April. So I think we're maybe adding more into this than that should be.
Well, that might be, but, you know, until we see some, you know, maybe some more trends to see where we are, we can adjust it. But there's enough fund balance at the end if we were even 20,000 short, you know, we have an anticipated 47,000, which is still way more for percentage for compared to expenses. You're a very healthy fund balance. So I think that's the difference. Like I said, I think it going forward, this fund will be in good shape. If we need to come back in and do a budget adjustment because, you know, the trending is not going to meet expectations, then we can go in and make a recommendation to adjust the budget. But at this time, I'm confident that we should be in good shape. Any questions?
Kathy, do you want to take a look at that revenue numbers that Josh talked about, or are you comfortable with using that at this time?
I'm comfortable in using it this time. From the simple fact is, you know, if it is overstated, I'm thinking it might be overstated by about, you know, maybe 5,000 or 6,000, because, you know, we're looking at as of September, I'm looking at 96,000 already, and you're looking at another quarter of billings, maybe, you know.
Yeah, if you look at where we are at the end of September and then just dividing that by 9 and
Yeah.
3 months worth, it looks like you're fairly accurate on the numbers that you put out.
So, you know, like I said, we can always come in and if we're seeing trends go that, you know, he's not getting the renewals for subscribers, that we come in and make a recommendation that, you know, we readjust the budget and remove items from it. It's not that council can't do that kind of stuff with a recommendation from finance. I've been there, done that. So, but I think this is a good budget. Not as conservative on the revenues as Josh probably wants, but I think it's still a good budget.
Well, there's two good things then when we talk about 2016. One, we're done with the AT&T, so we don't have to worry about that anymore. And two, we're adding to our fund balance in library fund. I guess there's a third thing too. We're also taking some of the general expenses and putting them back into this utility So it's moving in the right direction the way that we were hoping it would when we originally started. So those are three good things if it all works out.
Yeah.
Anybody have any other questions? Again, this is one that we were hoping that you would feel comfortable enough to approve tonight. If so, I would be looking for a motion.
Mayor, I'd move that we approve of the 2016 Waupaca online budget with no rate increase.
Motion by Mayo, second by Olson, that we approve of the Waupaca online budget with no rate increase. Any further discussion? All in favor signify by saying aye.
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 Against? Motion carried. All right, let's move on then. These are to the funds related to our general taxes. And under 7, we have the general fund. Is this the order you want to go in?
No, I think what I have is that,
Oh, you have library in the packet.
I have the library in the packet. It's up to everybody how they want to do it, but we can look at the library. Otherwise, I would like to handle the general fund first because I really think this is where most of it is. And some of the stuff that was presented for the library at the last meeting has drastically changed. And so I want to show you how we've put it into the general fund. Unless everybody wants to see what I did with the library first and then
The order
go
you
for it.
want to go here.
The general fund right now, based on our last meeting, had about, with that 1% increase in employee salaries, about a $200,000 hole to fill. And thanks to the staff, the other department heads, and some other balancing, one of the scenarios for the general fund, and I'm going to give you 3 of them tonight, is that we filled the $200,000 hole. We have a use of $40,000 of the airport tax levy. And what that does for the airport fund would be to make them use $40,000 of fund balance for operations and still go out and borrow for the tarmac project for $40,000. The other one is the street superintendent we had discovered was not being allocated to the water and sewer utilities, so Roger Hansen's position was not allocated, although Justin's, the director's position, was allocated, and allocated 15% of his salary and benefits to water and 15 to sewer, and that was included in that those budgets you did adopt. The other one is there's a 2016 permit revenue estimate that would include the Bethany permit. We are looking, because of a timing issue, that we would issue and record that permit in 16 instead of 15, because 15 right now, based on the permits pulled for work so far this year, is already exceeding the budget for building permits. The other one is to Aaron brought up that our revenue for the senior trips was not matching the expenditure, so we increased the revenue line item for the senior trips. Now that's a match because whatever they bring in, that's what they spend on their trips, $5,000. We also did include a possible land sale of $10,000 for the city land that's behind the Taco Bell property, and Aaron had got an estimate of that possibly being worth $10,000 to the adjacent landowner, or putting it up for sale by itself. So that's more realistic, although it is a one-time fill type of revenue. We received from the police chief removing all of the adjustments for retirement payout, recruitment. The vehicle's gone into capital outlay, and instead of a 1.5% increase, we put in a 1% increase. So that saved us about $50,000. Adjustments were received for various line items from community development, the finance department, parks and recreation line items, all either moving it to separate funds or reducing the request amounts for about a total of $15,000. And my recommendation is to bring in $25,000 of fund balance reserves from the debt service fund. On your financial statements, you have accumulated about $621,000 in your debt service fund. Some of it has to do with the amounts that you need to have set aside for your CDA lease revenue bonds, that you have to have money set aside for that debt service each year, but there is additional funds available, and my recommendation would be is to just transfer that little $25,000 that was from prior year's tax levy that wasn't spent maybe because of refinancing, that we would use that to fill in the last hole within the general fund, and that would balance the general fund. That's scenario number one. And that still would leave your ending fund balance of little over, almost 31% of total expenditures. So you would have a very healthy fund balance in the general fund. So we were able to fill the requirements. The other option, next page. The other option is several aldermen have asked me to look at funding some retirement payouts. And the other option is because of the amount that we have in fund balance in the general fund, the request, or the amount that I'm looking at would be to put $120,000 in into a contingency account. I put it right now just in other general government. I would earmarked it for retirements. The other would be is to put it in the council budget and recommend that the council only has majority vote to use that to use for payouts instead of waiting for the payout to be made up with vacancies. That would pull $120,000 from fund balance and still leave you with a ratio of a little over 27.5%. The other issue is that this helps in filling the expenditures that were removed from the general fund by moving the library into its separate fund, and gives us, as I would say, $120,000 cushion to continue to qualify for the expenditure restraint program. The expenditure restraint program is about $189,000 of revenue to the city, and that if we did not qualify for it, we would lose all of it. And that the program is that your general fund expenditures year to year cannot go over the CPI that the state sets, and that's, I think, September, based on September CPI in, I think, Midwest or Chicago. It's an expenditure program that when inflation is very low like this year, a lot of municipalities may be unable to, because of costs, to qualify for that program. So you don't, and I've seen what you've done in the past to continue to qualify by putting, credits within within the expenditure lines instead of showing them as revenues, and doing some offsetting. So I think this is a good practice to get into, and that way you have funds within the general operating fund for those retirements that aren't anticipated, or when, we need to have some room to qualify for the expenditure restraint program. So that's scenario number 2. Scenario number 3 for the general fund is to continue to fill the hole for the expenditure restraint program. And now I haven't touched any of the tax levy. I haven't touched any of the other line items, is to bring the airport fund back into the general operating budget. This is a profitable fund. The way Pete's been managing the airport has been very, very positive. The fuel sales that he has out there has been pretty much what his generation is for income and his rents. So to bring that in and still continue to have $120,000 in contingency leaves us with only that we're short $91,000. In the additional $40,000 that would cover the shortfall in tax levy for the airport now would just be assumed with the fund balance that would be brought over when we bring the fund into the general fund. And you're still looking at a fund balance of 28, almost 29% compared to ratio to expenditures. So I have three options for the council to think over. There is no action tonight on the general fund. The general fund has to be approved after a public hearing in November. So I'm not asking for any action. I'm just giving information out to you. This is me doing my job as a finance director and showing you what you have for options for funding in the next year. So we'll get on to the library. Do you want to bring the library up?
Anybody have any questions on what those 3 scenarios that Kathy has shown us? Scott, go ahead.
I guess it's more of a comment. I've never been comfortable with this possible land sales we always put in every year, because it's...
Well, it's not $75,000 this year.
Right, I know, but it's 10,000, and it's these other categories are, we know we're going to get them, they're there, but...
Yeah.
Yeah, Scott, the piece of land that we're selling actually typically may be higher. Not saying that $10,000 we're going to sell it at that for sure, so you're right, it's not 100%. But that is a very conservative number that Kathy came up with for the sale of that. But To your point, yes, we can't guarantee that we would sell that then.
You know, properties can sit for 5 years. I guess I don't wanna, it'll throw us off 10,000. I don't know if Kathy, that'll make a difference. I mean,
10,000 isn't a difference, so instead, instead we'd pull from, we could do two things. You could tell me to pull $35,000 from the cash that's in the debt service fund to fill that hole, take that land sale off. I don't have a problem. We could still pull it from the general fund's reserves. I would start using some of that debt service levy, you know, that has been sitting there for a while, and not put in a land sale. Like I said, land sales I've normally seen budgeted for, one, that they're almost guaranteed, and two, they're in like the capital improvement fund. They're just out there to help in funding one-time purchases, not operations. So.
okay, well, thanks.
Can I just ask Tim, this 50,000, did you agree on this?
Well, I'd rather not pull anything out, but I think at the, it's not really harming my budget that much. We're gonna be able to make up for that, and putting it into a capital expense to have to borrow for it isn't ideal either. Ideally, I'd like to keep it in my operating budget, but that would require, you know, another $25,000 or $35,000 being cut somewhere else. So I guess it's the best of the possible options that were out there. Otherwise, we wouldn't get a car at all. So, yeah, given the financial circumstances, I think it's in our best interest to proceed with that.
And I'm also, if we do the pull from reserves for the retirement contingency, that would cover that $20,000 at least that you had in the police budget for that retirement. So I kind of covered it in option number 2 and 3.
Maybe change his mind too.
And the other option that we have for funding the car is to, again, put the money in, move the money in, the cash from debt service fund into capital outlay and buy and pay cash it that way. I just don't want to see those large capital outlay items within the operating budget. I'd rather see that in the capital fund where it's a one-time deal and it can be tracked much more easily with whether it's borrowed funds or not.
But it isn't a one-time deal.
I know it's going on, but if next year when we do in the capital planning, that's where we can build in that car every year instead of having it in the operating budget. It's just easier to track your assets in the capital fund.
Anybody else have any questions on this? Okay, and as Kathy goes through this, she is going to, of course, tell us what the effect is on our levy and also our mill rate as we get to the bottom line. You might have more questions when we get to that point.
So the library fund is now been changed in that we removed the additional levy that would be required to move the 75% operating costs of this building into the library fund, and that Peg would just use what she's done in the past is whatever we have in expenses in the general operating budget to fill out her report for the Department of Instruction for her annual report. The other change in the library fund is the recognition of about $40,000 of outside donation and revenues that were directly offset to the expenditure accounts. So in my terms, it's called check booking. So if I get the money, I put it in the account and I spend it. Well, in government accounting, it's required and recommended that you put out where your funding sources are, so that if I have in grant and donations, and some of those are in miscellaneous, because they're not charges for public service, and they aren't intergovernmental, and they're not taxes. So they fall in this miscellaneous category. So I went back to 2013 and pulled all the receipts that were offset within her expenditure lines. Same thing for 14 and up to 15. And asked Peg to recognize for her fund that she has about $40,000 worth of outside money to spend in her budget. But I also did put in that 36,500 in donation expenses. So you can see that new line item out there that's donation expenses, that in 13 there was 39,000, almost 30,000, 14 was 33,000, so far in 15, and I forgot to change the header on that column, is 32,000. So we did anticipate that there would be 36,500 worth of expenses, but I also showed that she would be getting $36,500 worth of donations. And all it is just so that everybody knows that she does bring in revenues, but that does not help her in the formula for reciprocal borrowing for costs. It's outside what her costs are to get reimbursed by the county. So I just wanted to make sure that everybody knew that these expenses and these revenues were out there. And the nice thing about it is she does raise more donations and doesn't spend it. That fund balance where it's negative here, revenues under expenditures, is just for comparison only. That would flow down to her department and be able to use for offsetting expenditures in the future. She's held at property taxes at what she would be required to have for the 2015 budget, which is $351,454. So there is no tax levy increase that's necessary to fund the library.
Kathy, what's a donation expense?
A donation expenses is if she got something from the Foundry to help her with what her programs are. From my understanding is the library doesn't charge to put on any programs. They use the donations and other methods to fund those programs. And so my expense would be those were over and above. So if you really looked at it, she did spend, if you took out the amount of the budget, her budget was $757, and really what she's been spending has been almost $780 a year. So those are on the programs that she is putting on because she's getting outside funding to do those programs.
Their expenses funded by donations.
Right.
Got it. Gotcha.
So that's the library fund. And that's why you're not seeing when you get to the levy portion, there is no additional funding needed to cover the costs of the building. We'll just use it for, she'll just use it for reporting purposes only. She won't assume the costs of that within her fund. And it doesn't do any impact for the general fund, is that it's been tax levied before for the building operations of this building and maintenance.
So, Kathy, if you were to put the building into the library fund, then those expenses would go under the expenses, obviously. The offset would be the general property taxes?
Right, we would have to probably transfer $105,000 worth of property taxes from the general fund that are associated with the operations of this building, correct?
Well, I think that's pretty important to understand that, council members, too, that when we look at this, the general property taxes look like, actually, the city taxpayers are paying less than what the outside, the outside areas are, and that's not really true, because we don't have building cost in, okay?
Great.
I think the other constraint as well, Mayor, is one of the real positives of moving this to a separate fund is to give, as Kathy talked about, that cushion for expenditure restraint. We want to try to add back, but leave a cushion. But you can't create a separate fund, right, if less than 50% of the revenue for it is at least 50% of the revenue has to be taxes.
Less than 50%.
Less
Less
than
than
50,
50% has to be taxes.
Right, to be create its own fund. So that was the other thing kind of driving the need to take that out of there.
You mean city tax?
Right.
Okay, because
Part of, for
the
our
county is
levy.
obviously taxes too,
Mhm.
paying that.
No, don't pay. I'm sorry. All of the people who live in the city of Waupaca don't pay for library services twice. They're exempt from paying that library service on the county bill. So you only pay for library services one time, not through your county too.
But county taxpayers are paying toward it. Yeah. So they are taxed.
Okay, the next fund I have is the debt service fund, and I have some very positive news for the debt service fund.
Well, you don't have a page number.
All right, the debt service fund. This fund is going to, the debt service fund is got some changes for you. And it's going to require you to, as a council, to make some determinations of the directions you want to go this year. One of the things that came out of the financial advisor with Ellers on the TIF districts is the fact that the CDA lease revenue bonds for the rec center and 3 other TIF CDA lease revenue bonds are now callable. These bonds are at 4% and require a reservation of debt service in advance. So we have, I want to say, I thought there was like almost $1.2 million out there that's sitting in investments for debt service, so that we don't, how would you say, default. It's the bank's cushion on these bonds. We have the opportunity to refinance these bonds this year with a state trust fund loan at 3.25%. Same term, you would have them paid off by, I believe it's 2018, that we would go out there and refinance the rec center and those 3 TIF CDA loans. The estimate from R.W. Baird, our financial advisor, is that we would save $1.7 million in interest costs by redoing that.
On all 4 bonds?
On all 4 bonds. The change just in 2016, if I would go in and refinance, would be $152,000 in tax levy that I would not have to levy for in the debt service fund for just that issue alone. for for next year's payment. The option would be is to to levy the amount that you would need and go out there and pay down some other high interest debt that you have. In essence, shortening up your debt service timeline. You've done it already with this year. We've got a $90,000 extra coupon that we're calling on a bond, which ends up pulling away the 2006 bond a year ahead of time. As you can see, there's the principal for capital 2006. There was $175,000 budgeted. There is nothing because that bond is paid in full, and you save the interest cost, which is about $1,700 or $1,800. So that bond got paid ahead of time. We could go out and, with that savings, go out and pay off some other some other coupons that are higher than the 3 1/4 that we would be paying, and just start paying down some of the debt. What ends up doing is that ends up compounding for next year, so that we would have less levy required for debt service, even with putting in a possible borrowing for the capital costs for 2016, we would have enough capacity that there wouldn't be an increase in the levy, and we would shorten our debt service requirements. Instead of maybe stuff falling off in 19, they might fall off in 18 or even 17. So there's some positives there. The other option is that you can use some of that debt service levy that you don't require to pay down and reduce your levy, and not go out there and pay, because it's going to start snowballing with the debt service requirements in the future. The other option is to look at that rec center CDA debt service would not be required until 2017 if I borrow early next year. I wouldn't need that, and use all of that money to pay a whole issue off. So this fund is sitting in a very good position to allow the council, and I'm going to show you after this screen what the impact is on the levy. But I thought that was very, very good news for everybody. You know, that those bonds became callable last year, and now going in and looking at that this is an option that we can bring in some additional funds and to be able to reduce the levy that would be required to give a tax rate decrease to the residents.
Kathy, where else did you look beside the state trust fund for?
Well, the biggest problem I have right now is because of our overall financial picture is I would not go to the market. You would have to go to the market to do that. I would not be able to go to a local bank and say, let's go out and refinance. Can you refinance this? I would go out and go to the state trust fund. One, it doesn't cost me any money. I don't need to have a financial advisor. I don't need to do an official statement. There's a lot of bond costs associated. You'd have to get a rating, maybe. So I think the fact that the state trust fund, I can get the money within 45 days, and it's at 3 1/4, I think and doesn't have any prepayment penalties. So if I wanted to, we could go out there, refinance it, and and then go out there and maybe prepay it.
And
So-
you said a local bank wouldn't be an option, why?
I don't know of any municipality that's really, for the amount of money that I'm looking for, to go to a local bank and get the kind of rate that I'm going to get from the state trust fund loan. Just even looking at the cost of the squad car to go out on a capital lease, one, they won't touch a squad car because it's, how would you say this? The possibility of that asset going away is more probable than possible than probable. So then if you're looking at it, then the state trust fund loan, and that was, even if they didn't do a squad car, it was going to be almost 4% for an equipment lease, a capital lease. I didn't get any call, when I talked to Chase, they told me, well, why aren't you going to a state trust fund loan? Because it's only 2.5% for 1 year. So, and there's no prepayment, there's no cost to me. So I think that's the only reason why.
What about using note anticipation notes for the first year?
There's still costs to do it. You need to have still bond counsel. You still need to have the financial advisor, and under Sarbanes-Oxley now, I have to pay them a fee to do that. So you don't pay me a fee to go to the state trust fund loan. So there's the cost involved for issuance. This is a good positive, even with pulling the $25,000 from fund balance to the general fund to fill the shortfall in the tax levy. This fund is still sitting on an anticipated $587,000 of cash. It could sit on even, it could help in reducing the debt. Your requirement for the next year might be less for debt service when we go out and do the final look at based on recommendations that I can hear from council. If you want to pay debt down, you have the capacity to do that. You also have the capacity to pay debt down and reduce the tax rate and levy with this. Do you want to go to the next slide? The next slide I've got is my tax rate calculation sheet. And this is assuming that everybody outside around us stays the same, that their levies don't go up, their levies don't go down. The assessed value of the city has gone down about $2.5 million, which automatically, even if everybody outside of us stays the same, the county goes up 4 cents. The technical college goes up a penny, and the school district would go up 6 cents if their levy stayed exactly the same. And that's not including the TIF increment. That's just their gross levy. I broke the TIF district out separately. The TIF increment is going down because of the change in the equalized value going to 100% of assessed. So our fair market value is almost right there compared to assessed. So there is a less increment that the TIF districts are going to get. So that also helps in reducing the amount. I'm looking at the possibility that we could have raised our levy $9,159 under the net new construction and the levy limit law. But I'm also asking as a recommendation of taking $50,000 off the top of that savings. You're going to see, one, in debt service that because we've paid off all from prior years, and to the refinancing of the CDA lease revenue debt. and that you could reduce your rate by 4 cents, even with the reduction in the tax, in the assessed value. You could reduce it even more, but I'm not recommending that, only because my recommendation is to start paying some of that higher debt down and continue to compound what you can get to with your debt service, and get you to that point where we start blending the debt service levy and bringing some new debt in and reducing the debt, so that the debt service levy would continue to go down, but it will go down, not down real fast. And then you'd have the spike of when you did issue new debt that you'd have to fill up, you'd have to raise the levy because you had debt service. So I'm starting to blend in the reduction, so that if and when you did want to do something with a new DPW garage, or that's when we would time that pull for debt service, should be blend right in there, and it wouldn't be that much of an increase to the taxpayer.
I think it's probably worth noting to the council, Kathy, that, yeah, our assessment's gone down. It's gone down for a couple of years in a row. There are some positives going on in this year that should get us going on an upward trend, but our assessment ratio is a little over 100%, so, which is good, right? It's assessed very close to market value.
Yes. I think that I had there was another one in there that I had, and that was just that it was just this is what if we did not pull $50,000 from paying future debt off, and with the savings on the refi, your rate would have gone up 8 cents. Because of the reduction in your assessed value. So you're in a good position to reduce the city's rate and still accomplish operations, paying additional debt down, and pay for put money aside for your retirements and stuff like that. I think you're in a really good position. And then I added the transit fund and some of the other funds that have, minimal tax levy. We are required to put money aside for the transit fund. It's $8,000 of tax levy. The biggest problem with that is we wait for the federal government to pay for us, so this fund is always in negative cash, because they're not good at paying their bills.
Well, they can't get a budget at the federal level.
Right.
They do all these continuing resolutions, and they can't get anything going.
Right.
So we all suffer.
The Adult Recreation Fund, Aaron did pull $5,000 for the costs of maintaining the parks and the rec center into this fund, but this fund is in good position financially, that the revenues and expenditures will blend and be able to support the programs that it has based on the revenues that it generates. And then the last one is the airport fund, and this is the airport fund that I'm recommending that we assume into the general operating budget to fill the partial hole, that making the library a separate fund. And by doing that, it's still generating enough revenue that it would help the general fund in fund balance to start putting some cash in there, because it is a profitable fund. to bring it in.
Kathy, the trend has been to pull funds out of the general fund for clarification. Now you're recommending or bringing forward to put the airport board back into the budget.
Well, the other option would be if we didn't do that, and and we can do it, it's not a big deal, is that you would then budget an extra $250,000 in contingency. What I'm recommending is that I don't want you to get into that point where for expenditure restraint, we have to think of something else to peel off. And so if we either fill in the library hole with contingency and some other stuff, or we can fill it in with the airport fund. It's up to, it was just a recommendation that I had. So, but I really think that we need to make sure that we show a reduction in the general fund, but I don't want to get it so tight that we don't have that room to grow for expenditure restraint and not qualify for $189,000, because $1 over will disqualify you.
I can relate.
That's in, Kathy, that's in budget, though, right?
That's in budget. It's not in expenditure. So my budget just needs to look like I am within $1 and 2 decimal points. When they tell me I have to be at 1.1 or 1.02, I'm within $1 of that dollar amount of what I need to increase my. That's the game we play with Madison.
So by putting the money into the contingency fund, if you wanted to keep the library funds separate, or even if you kept the $120,000 that one of her scenarios has in the contingency fund, if we don't spend that,
it doesn't
that still counts as an expense for us. So we can define what those restrictions would be on that contingency fund, on what we would use that for. You know, we even talked a little bit yesterday at a staff level about you would make it a super majority, whatever you decided to do in that contingency fund, you would have to have 8 council members agree to that. You follow what I'm saying? So it would be something that would have to be, well, for example, if you decided, like last year, where we had 2 of our public works, our street department people that retired, and we were going to see a decline in the snow removal because they retired in the middle of January. So we decided to use a fund balance to hire those people immediately. Okay, that would be what that contingency would be set up for. That would be one example where you could go after that. So again, this is thought. If you would like to see the library or the airport fund as a separate fund, you would just have to add to the contingency fund. It doesn't mean that we're going to spend it, and we would put restrictions on it that would be very difficult to use unless we absolutely needed it. Remember the old rainy day funds for some of you that were around a long time ago? That's kind of what this is.
And this is the budget way of funding your retirements, is if that's what you want to look at, or to have a one-time an extraordinary expense that came through, that something happened that we needed to fill in. I think that it's good business sense to have something built in your budget for those mishaps, bad judgment as to whether or not I'm going to spend that kind of, is that expense going to come in at the amount that I thought I could be, that I budgeted for? It's just, and it's just part of the program you have with the state in qualifying for it. Other municipalities do the same thing,
So Kathy, and I'm I'm just thinking for myself here, but if we look at your tax rate calculation worksheet, it looks like if you take the city and then the TIF, which are city obviously too, we're at about 0.7% decrease in the 0.7% decrease in the mill rate. So what if our direction from council was to say to you, we actually want to see a 2% decrease in the mill rate for 2016, what additional amounts would we need?
You'd probably have to pull about $150,000 out of the debt service levy.
And that wouldn't affect operations at all?
No.
It would just mean you would have that much less money in debt service?
You have the capacity to do that within debt service.
So if we were to go 1%,
You're probably talking another 75,000.
so to go from 0.7% to 1%, it would take 70,000.
Yeah. Additional. So instead of 50, you'd have to have another 75,000 out there.
Well, and truly that 50 is 75 because you're taking 25 and putting it into the.
Well, we're playing the levy limit game now. My levy has to stay like this. Now, debt service is one of those funds where I can increase for issuing more debt, but I also, because it's anything after 2005, if my debt service goes down, I have to lower my levy. So the only way you can keep that levy at that rate that you're at, because I could give you what the scenario is if I don't have any prepayment debt, is that I'd take all that $150,000 out totally, and that would be your levy for debt service. It could even go down even more if I didn't budget in the fact that I was going to refi the debt to the state trust fund loan, the CDA on the Hendrickson Center. I would go down another $350,000. The problem is next year for 17, now you're doing the roller coaster. Now I got the debt for the capital program, and now I've got the debt for payment for the refi. Now you're going to go up, and you don't want to get that because now your levy is going up and down, up and down. So the recommendation has been that you blend your rate. So you had debt fall off. Well, then if you instead, if you're not going to fill it all the way, then pay some debt out that you have out there that's at a higher rate. Sooner or later, you're going to get to that point where the levy's going to go down because you have no debt to prepay. So it doesn't make sense to do that because it'll go down so that you might only see $1.25 of the tax levy is for debt service instead of $3.
Anybody else have any other questions? Kathy, anything else that you want to?
No, but other than my eyes are really tired from looking at a lot of numbers. I came in at the beginning of the year thinking that I was going to have some struggles, and by putting in some of the advisors that I've done with the TIFs and talking to everybody, I think that this is a very, very good budget for everybody here to be able to come in and say, because of what we've done, actually what you did last year by paying that $90,000, that gave you this option to play around with reducing the rate and the levy. And it'll help you going forward. to start paying down some of that higher debt that's callable.
Okay. Any recommendations from council? This is going to be on not our next council meeting, which is next Tuesday, so it will be
17th. The public hearing's on the 17th.
17th. Now, in the paper tomorrow, you will see, and it is attached on there, is the public hearing notice. That was as of the picture, that was as of Monday morning. So all these little different scenarios have developed since that got sent to the papers. So there's changes that you have here. So if you have questions about what was published, maybe, you know, I can do a redo of the public hearing notice, but I think if you get any questions, to have them refer them to me, and I can be more than happy to explain stuff.
Anybody else? I guess, go ahead, Scott.
Will we decide at the 17th meeting then if we're going to refi and all these other things, or?
You can, or you can, you know,
When will that take place? We have to.
it would be the 17th that you would do the public hearing to
We'll
set
have
the debt
various
service
things
levy.
to decide, is that what I'm hearing?
Well, if we approve the budget, that, assuming that we're gonna do the refi, so we'll probably make that before we actually do the budget.
Okay, yeah,
That makes sense.
yeah.
Absolutely.
Mayor, it's just a thought, maybe we should bring this, or at least discuss this at our first meeting if we can, and maybe fight it out in smaller chunks than all on the 17th.
Well,
Just a
the
suggestion.
agenda for the first meeting is done. And, I mean, we could probably do an addendum to that if we wanted to do that.
It's just a thought, you know, I'm just throwing it out for what people think.
And just for your information, I will not be at that meeting. I have training on the new software in Madison starting next week, Monday, so I will not be at the meeting.
Anybody else?
Well, Mayor, I guess, speaking, I guess for staff and probably mainly for Kathy, is the scenario on the mill rate reduction where you want it?
Well,
Tax rate, or do you wanna bring something at 1%? And then
That's
she
what
can
my
make those changes, and then if you guys are in concurrence right now, then that's done. You don't necessarily have to talk about that. Because
That was my
your
question.
pages will reflect that.
Well, the point is tonight, that this was presented again. This is the second time we've seen it. And we're gonna have discussion, obviously, on the 17th of November. But that's, you're reading my mind a little bit, Henry, too. I think, you know, we're looking at like about a 0.7% decrease in the bill rate. I would like to see us round that off to 1%, as long as we know that we're gonna use debt service money to do that and not, you know, into department expenditure.
It's from the savings from the refinancing, so essentially,
The savings from the
you're agreeing
refi,
to the refinancing by doing that, setting that mill rate.
right.
Even if we don't do the refinance, from what I can see here, is the debt service has a positive cash flow that will give.
That would be another option to use, is some of that debt service cash. Like I said, in the past, I've never had a debt service fund that had a fund balance. So it's normally 0%. What you levy for debt, you pay for debt, so.
Paul Mayo has.
Yeah, I'm going to disagree with that a little bit. We have a 0.7% decrease. My preference would be to have just a level mill rate and use the savings to pay off more debt. If we don't use that debt service fund to decrease the mill rate, if the mill rate just remains flat, we will be able to pay off more debt, correct?
Correct. The other option would be is not pull 50,000. I think the minimum to get a 0 was like 20.
So,
I could get it so that the rate with the reduction in the assessed value is 0. You would still reduce some of the levy from debt service, but you wouldn't, and you'd still be able to pay off a lot more debt with timing, and I think that's in the 17th is what I'm going to give you is the next scenario is on the debt services, this is where the trend is. If we continue this is the way it'll come down, and put in some anticipated new debt, so that you can see where that plateau is, where if you wanted to do that DPW building or fund Main Street's reconstruction, that's where this would be the time to do it.
okay, so that we don't have to go to blows on this, I mean, maybe you can bring both scenarios forward, and we can discuss.
I'll bring some, on the 17th, I'll bring some more options, and it's not a hard deal. I've created the worksheets so that whatever you tell me, it'll link it all together, and I'll be able to tell you what the option is.
Are we okay with that?
That's what I was kinda after. We had a lot of things to decide when we were gonna decide them, so that sounds good. I mean, we need a couple more pieces of information.
The only other piece of information I want to give you, and
Brian,
it's only
can I ask
because I
another
heard it on the radio, is that,
Can I ask another question? Are we still in that?
sure, that's no problem, you can interrupt me.
I'm
Go ahead,
sorry,
Paul.
I just thought we were still in discussion or questions. If we reduce our rate next year, and then in 17, we can't, am I correct, we can't recoup that if we wanted to because, okay,
Because it's debt service.
okay, that's what I want to know. Thank you.
What I'm already recouping is that net new construction of .26.
Okay.
It's built in there as that $9,159. So I'm already grabbing it. Because the debt service is another section of the levy limit form. So whatever my debt service is and what my debt service isn't, and it nets out, but it's strictly the levy for operations.
The only other thing I wanted to bring up before we talk about adjourning, if you listen to the radio today, WDUX, the county, I'm pretty sure agreed to a 1.5% pay increase. Is that right, Jack? Was it the county? Which?
The county was proposing a 1.25
Okay.
salary increase for their employees, those that aren't in line for a step increase.
Okay. Okay. I knew it was more than what we're offering, so something for you to think about also. Don't forget that our employees are actually going to end up in the negative this year because they are paying more towards their health insurance in 2016 than what their pay increase is going to be in 2016. Again, just keep that in mind. Look at. Anybody else? Thanks, Jack. Motion to adjourn? Anybody?
So moved.
Second.
Motion by Keelan, second by Hagan, that we adjourn to our next regular scheduled meeting.
Thanks for tuning in.
All in favor, signify by saying aye.
Aye.
Against? Motion carried. We're adjourned at 7:28 PM. Thanks, everybody.